Welcome to Influential Entrepreneurs, bringing you interviews with elite business leaders and experts, sharing tips and strategies for elevating your business to the next level. Here's your host, Mike Saunders.
Hello and welcome to this episode of Influential Entrepreneurs. This is Mike Saunders, the Authority Positioning Coach. Today we have with us Fred Cook, who's partner and wealth advisor with CAVU Financial, and we'll be talking about portfolio preservation. Fred, welcome to the program.
Good morning, Mike. Welcome. Nice to be aboard here. Thanks for inviting me.
You are welcome. I'm looking forward to talking with you. And I always love kind of like, what do you think first when you hear this word? So when I hear portfolio preservation, it makes me think about all the time that it takes to build and grow a portfolio of investments. Well, now you better put that blockade around it and preserve it. So I'm excited to learn from you, but let's first jump in with give us a little bit of your background and story, and how did you get into the financial services industry?
Well, Mike, I've been in the business of financial services basically my whole career. So, we're talking 40 plus years, three different organizations, et cetera. And it was really in the banking world that I got started. And eventually, I was actually with an insurance company for a while. And about 10 years ago, I retired and joined a firm called CAVU Financial, and I have two partners, and decided to go independent and basically work with my clients that I accumulated over all those years. And that's kind of how I got in the business and kind of where I'm at right now. I did want to make, before we get too far along here, I wanted to keep our lawyers happy, but really it's important. Our firm, CAVU Financial, LLC, offers securities through LPL Financial, which is a member of FNRA SIPC. Our investment advice is offered through Stratus Wealth Partners Limited, which is a registered investment advisor. Stratus Wealth Partners Limited and CAVU Financial, LLC are separate entities from LPL Financial. Also, it's important to realize that anything that we talk about today and any comments that I make are general in nature and really not intended to provide specific advice or any kind of recommendations for any individual.
Sounds good.
Okay.
One thing that I was thinking when you mentioned you came out of banking and then created your own firm with partners and as an independent. So the word independent jumps out of me because I know that working for a large institution, and you didn't mention the name of the bank, and it doesn't matter, but typically you kind of trying to fit square pegs in a round hole, and like you can only offer certain products. And there might have come a time where you're like, wow, Mr. or Mrs. Client, I wish that I could, it's almost like you're thinking this, you'd never say it, but I wish I could offer you something better because I'm limited to this. And is that kind of one of the impetuses that you found when you wanted to break out on your own to say, wow, look at this plethora of opportunities and options I have to now bring to my clients to serve them best?
You zeroed right in on why I left the bank. I actually retired. But I was sitting in front of a client, and the portfolio manager, I was a private banking officer, and the portfolio manager and I were sitting with this client who had really gotten beat up in the 2000, 2001 tech bubble, and just finally got back to zero in 2007, just in time to get beat up in the 2000, 2008. And so he was, we kind of got involved with him after those two things had happened to him. And I had been using a system, and we'll talk a little bit about it later, but where we really work to avoid those types of things with our clients. And I was doing it personally for myself. I couldn't do it in the bank. And the client asked, hey, if we go through another 2007, how much money am I going to lose? And without blinking an eye, the portfolio manager said $1 million. And the client was like, you've got to be kidding me. I just got done telling you I can't afford. I'm older now. I'm getting closer to retirement. I can't go through that again. And, we had him in pretty much the standard 60-40 portfolio. Yeah. Now, I was sitting there at the table knowing that I had the cookie. I knew how, and I couldn't bring that to the table because I wasn't independent. I couldn't bring solutions to the table. My partner, who spent 24 years with another large broker dealer, had the same issues. He was being told by the broker dealer what mutual funds he could sell and go out and push these things and push those things. And we both kind of determined, it was time to get out there and be independent of all of that, and really just work on behalf of what our clients want as opposed to what our
Yeah.
firms want us to do.
Well, that sounds amazing. It sounds very different. So, talk a little bit more about what's different about your approach to investment portfolio risk. Is diversification the answer?
Well, Michael, when you asked me to join you today on this podcast to discuss what kind of risk people take inside their portfolios, you asked me to think about some questions that I get in my practice. And I thought about it. And, I've been doing this, as I mentioned, for a long time and have received a lot of questions about risk with inside a portfolio. And I end up sort of being like a human Google when discussing portfolio risk with my clients. So after I thought about it, I realized that people really ask the wrong questions. If you want, I can share some with you, but what I hope to accomplish today is helping your listeners determine what should they be thinking about as it relates to risk, and what questions should they be asking themselves and their advisors. The biggest mistake that investors make, and I think I heard you mention this on a podcast of yours, but not knowing what they don't know.
Yeah.
Ignorance is bliss, and people aren't even really aware of what risks they actually have within a portfolio, so they don't even know what questions to ask. And so,
That's a pretty big point, because a lot of times I say to people in financial services, hey, you're sitting with clients talking about their retirement, but in reality, before you get into the numbers, you've got to find out what retirement means to them. What are they planning? What are they thinking? Are you going to start another business,
right.
consulting firm, nonprofit? Are you going to travel more, so that you know what gap that there is? So I always say you almost become a life coach of sorts. Well, that means that you need to ask the right questions. And that's exactly what you're saying there. Know the right questions, because if you don't know those questions to ask, you might be going down one path and you should be going down another.
Correct. When a client and advisor sit down, for example, to talk about risk, and I'm talking about risk within an investment portfolio. There are all types of risk, but let's focus on the investment risk that a client takes. As an advisor, I know that within investment risk, there's market risk, interest rate risk. I read an interesting book called The Seven Faces of Risk, actually conquering the seven faces of risk by Scott Judds. And he points out, in addition to the ones we think about, several other unique types of risks that are hidden inside a client's portfolio. But more often than not, when the advisor talks with a client about the risk, they're really thinking the advisor risk of volatility. How
Mm.
volatile will the portfolio be? Think of it as a staircase. Generally, it's heading up or down, but there are stairs which are zigzagging up and down. The bigger the zigs and the zags, the more volatile or, quote, risky a portfolio is. Interestingly, a portfolio that's considered less risky, okay, which has small zigs and zags, um, even if the staircase is heading down, will lose money.
Hmm.
But what is the client thinking when you say risk? Pretty simple, isn't it? Not losing
Yeah.
money. So right out of the box, there's a disconnect where clients think they are safe, quotes, because their advisor told them so. But in reality, they have the potential to lose money. And historically, as advisors, we made this worse by trying to determine how much risk our clients were willing to take. Now, remember, there's a disconnect. I'm thinking, as the advisor, volatility, clients thinking not lose money. So we ask all kinds of questions around their thoughts about losing money, and what will money be used for? You just mentioned it, for retirement, that type of thing. When will they need it, et cetera? And then we would add it all up and we'd come up with a score based upon how they answered these questions. And we would determine their, quote, risk tolerance, right? And then we would come up with terms like conservative, moderate,
Mhm.
aggressive. You're a moderate investor, Mike. You're a moderate, and everybody sat around the desk, me
Like, yay,
included.
what does that mean?
Yeah, yeah, this is great. We nod our heads like a kumbaya moment. Everybody's like, oh,
Yeah.
feeling pretty good. And the client would say things like, yeah, I feel like a moderate investor. Yeah, that's great, or aggressive, whatever it was. And at this point, the client advisor, you just mentioned it, have no idea what the expectations for losing money
Mm.
or making money are. In general, again, the client was thinking, I can take some risk, lose a little money from time to time, so I can make some money. But you know what, Fred? Not too much. The
Yeah.
advisor was thinking, well, they can accept their moderate amount, whatever that meant, of zigzagging in their portfolio. And that was the problem. There were no expectations. But as a consumer, we need to rethink the questions. And here's where we get into the questions we need to be asking ourselves and our advisors. And this would be something like, how much money can I lose without it affecting my future lifestyle? Now, this is difficult for people to get their heads around. So I like to simplify it. Ask yourself, how much money can I lose before I fire my advisor? For example, 6 months from now, your $100,000 portfolio at the beginning of the year, okay, or now, you look at it 6 months from now, lost $25,000. Is it time to find a new advisor? Once you determine how much you can lose without affecting your future lifestyle, we call that your capacity for risk. What is your capacity for losing money? That's really what's important when you think about risk. The next question would be, does your portfolio that you currently have match that newly discovered capacity for risk? Put it in simple terms, Mike. Say you would be okay with losing $10,000 in 6 months. Now you're not happy, but it's not life altering, or is it getting to the level of firing your advisor? Now, under certain historical situations, how would your portfolio perform? We call these stress tests. And look at the financial meltdown of 2007 and 2008, or March of 2020. Or how about, and this is important, more recently, January 1st of 2022 through September 30th of 2020. I think we're 2023. I'm sorry, this year, January 1st of 2020. No, 2022. I'm right. January 1st of 2022 through September 30th of 2022. Most folks would be shocked to learn that while they would be okay with a $10,000 loss on their $100,000 portfolio, the portfolio had a potential for a 6-month loss of $20,000. So it can be, it can be
it's
quite
that
dramatic.
sock in the, it's almost like that sock in the gut when you're
Correct.
when you're reading the news and hearing, oh, the market, this, that, and the other, and all these things, and you're like, what does that mean? And I really like your analogy or your questioning about what's your capacity for risk. And like, I think that sounds like a nice flowy term. What's your capacity for risk? But when you actually say, at what point would you say to your financial advisor, you're fired? That kind of brings it home, right? So once you've determined that capacity, what are your next steps?
Well, you've guessed it, Mike. We're going to ask more questions. Okay.
Yeah.
In the example we just discussed, the strategy often provided, and this is probably the standard strategy that is used almost universally, is a 60-40 balance of stocks and bonds, where you have 60% in stocks and 40% in bonds. And that's sort of a first level of diversification. And then we take, and within each of those, we have a diversity of what types of stocks, and we have a diversity of what types of bonds. In other words, don't put all your eggs in one basket. We've all heard that. But did you know, and I'm going to go back to my January 1st of 2022 to September 30th of 2022, all diversified portfolio of 60% stocks and 40% bonds was down almost 20%. And how happy do you think a client would have been looking at their statement that was $100,000 and it's now valued at $80,000?
Yeah.
How much does that portfolio have to gain to get back to $100,000? If you said 20%, you'd be wrong. It has to go up 25%. And how long will that take to happen? And that's just to get back to even.
What that presupposes as well is we need to layer in even more risk to get that 25+% to get back to ground zero. And then when you have more risk, then you have more chance for more volatility. So yeah, it's just like that, a vicious cycle.
It's exactly what it is, right? And so, what we do at that point when we have these discussions with client is we try to make sure that we stress test the portfolio so that it does align with their expectations. It's not going to be down 25% or 20 when they were expecting 10. And usually, historically, this meant to further diversify, just the opposite of what you said. In other words, oh yeah, we don't want 25 or so we're going to go even less equities and more bonds, that type of thing, to be even more diversified. Okay. And that does, and it may work to lessen volatility. In other words, the zigs and the zags. But it oftentimes results in severely limiting the overall growth of the portfolio. Yeah. Think of it as wearing an all-weather outfit. On the right side of your body, you wear a short, t-shirt, and a sandal. On the left side of your body, you wear long pants, a parka, and a boot. Okay. This way, you're diversified, right? You can survive the weather no matter what it is. But if you think about it, you will always have the wrong outfit on for half of your body, creating an uncomfortable situation no matter what the weather. And so that's some of the issues that we have with the diversification as the answer. So here are some questions that I think you should ask yourself or your advisor some more. What happens to my portfolio if we have another 2007 to 2009 bear market? And on the flip side, what happens to the portfolio if we have another 2009 to 2021 bull market? And then what would be the overall return from 2007 to 2021 on that portfolio? And then this is important. How long would it take for the portfolio to recover from losses incurred in the 2007 and 2009 bear market? And then I like this one because it's more recent and it's fresh in people's memory. How would your portfolio perform from January 1st of 2022 through September 30th of 2022 when both stocks and bonds went down?
I think with all those dates and what ifs, it makes me think of something. You ever heard of that book called The Blue Ocean Strategy?
I've heard of it, yes.
The concept is, in anything business wise, you don't want to be over in the red ocean where all the chum and the sharks are fighting for, scraps of fish. You want to be way out of the horizon where the blue ocean is, where it's nice and smooth. Well, guess what? In investments and portfolios and all of these things we're talking about, it's probably pretty rare that we have blue ocean all the time. We know that there's going to be volatility, maybe bear market, bull market, maybe a mix of two. And I think that's the whole point is you need to have a little game plan playbook for each time, if it's fully on bear, fully on bull, or a little bit of both. So when we are talking about now this investment risk and all of this volatility, how do you take all of that we've now uncovered? Because some of this, you just didn't know what you didn't know until now. How do you take all this and apply it to portfolios of investments for your clients? What are you doing? And then how are they experiencing good results?
Well, we follow the principles of what we call dynamic risk management. And it's a tactical approach. In our business, you can have a more of a strategic approach or a static approach where you just sort of buy and hold. And then once a quarter, you kind of rebalance it back to the 60-40 or whatever. But we would rather use a tactical approach, which combines the theories of relative strength and momentum. We don't base our decisions, what we do for our clients, and what we think the future will be. We look at what it is today, what it is and where it is today. The market tells us where it is today, and momentum gives us the guidance that the situation that we're in should exist somewhat into the future, days, weeks, months, whatever. Think of it, Mike, as a tug of war. You've got equities on one side, bonds on the other. Who's winning? That's relative strength. We have a way of analyzing that to see who's winning. And we can do it not only with all stocks and all bonds, we can do it within like is growth versus value. We can do a relative strength, who's winning that tug of war. And we actually strive to position our portfolios on the winning side, knowing that it has an historical probability. It doesn't always work, but it has an historical probability of continuing to win. And that's momentum. In the end, we win by not losing. That's how our customers have done. Mm-hmm. If we're wrong, let's say we get in and we think we should be out of the market because the bonds are winning that tug of war and we shouldn't be in equities, right? Well, if we're wrong, we tend to be on the wrong side for just a short time. And that allows us to take potentially smaller losses than we would if we just sort of bought and held. And our clients actually over the years, and we have historical numbers and proof, we can show everybody how this has all worked out. But yes, we've been able to avoid in the past, we've been able to avoid some of these big drawdowns that we've all had to experience that I've sort of mentioned prior.
Well, Fred, these have been some super powerful questions that you brought up. I really love how you've positioned that, because when we ask the right questions, we get to the best answer. So let's wrap up with any final questions that we should be asking about volatility and risk.
Sure. The first thing that you should do is, what is your plan? Okay, do you have a plan for your investment portfolio during the next bear market or recession? You know, we all think they're coming, right? The recession's going to be here, blah, blah, blah. We might be in a bear market now. You know, who knows? But what's your plan? What are you going to do? You're going to just sit there and hope for the best? The second question would be, how much risk do you need to take to get where you want to go? And that's a loaded question. You mentioned it earlier. You got to figure out where you want to go first. And then the third one was, and this is one that everybody knows. This is one I've been getting forever. Will I run out of money after I retire? People worry about that, and you're not making any money, and you're going to run out. And that's probably one of the first most important things we look at with clients. So
yeah, that's huge.
Yeah.
So at this point, once people have listened to some of these questions and maybe answered them in their mind, I think that they're going to have even more questions. So what are some of the best ways that people can learn more and reach out and connect with you?
Well, if your listeners want a free risk capacity analysis, all they have to do is go to my website, CAVUFinancial.com. CAVU stands for Ceiling and Visibility Unlimited. So CAVUFinancial.com. And on that website, there's a button there called What's Your Risk Number? And when you click that button, they'll ask you, there'll be a questionnaire that'll come up. Now, that questionnaire is based on a process that we put together, built on decades of behavioral economic work, and not limited to, but including a framework called prospect theory that won a Nobel Prize for economics back in 2002. But anyway, complete that questionnaire and I'll email them their results and what those results mean in actual dollars. So, percentages don't mean a lot, but when you see in dollars what you have the potential, what your risk capacity is. By going through that process, you'll have a good idea of what your risk capacity is. And then finally, as a way of thanking you, Mike, for allowing me to share my thoughts today on your podcast, if your listeners mention the podcast, I will be more than happy to provide them a complimentary report which analyzes their current portfolio to see if it matches their risk capacity. Now think about it, Mike. If you're armed with your risk capacity and the risk within your portfolio, you'll be well prepared to have a meaningful discussion with your advisors.
And once that is done, that brings up a potential gap of, I'm here, I think I should be there, but I'm not. So what should I do? So I think that opens up a great opportunity for even more questions there. So Fred, thank you so much for coming on today. It's been a real pleasure talking with you.
Thank you for having me, Mike.
You've been listening to Influential Entrepreneurs with Mike Saunders. To learn more about the resources mentioned on today's show or listen to past episodes, visit www.influentialentrepreneurssradio.com.